For the first time in decades, Canadian real estate is healing. If you're a first-time homebuyer who has thought that you would always rent, what is happening right now will change your future. And I will go into detail about what is happening and how to take advantage of it. Before I do, I think it's important to go back and figure out how we got. So why should you listen to me? My name is Jeff Dinsmore. I'm an investor-focused mortgage broker. I've helped 1,000 people earn hundreds of millions of dollars in real estate. And when we go back to a time, it was 2000 to 2005, and this crazy thing happened. Builders would build homes for people to live in. I know it's crazy, but there used to be a time where builders would actually go to build homes that people wanted to live in. Over time, things started to change. Investors became a larger and larger pool of the overall purchase, especially of these new builds. And we went from building homes that people wanted to live in to building homes that maximize the amount of rent that you get for the purchase price. And I remember there was a time specifically where we ran real estate investment seminars, and no, they're free. They'll always be free. I'm not going to charge you for any of my content. I believe in giving you information for free, and that's why I'm here today. But we're at one of these seminars, and there was a realtor who was selling these pre-construction condos who was arguing with us over how, when we talked about making sure a property earned enough rent for the expenses, that we were wrong. It sounds crazy to think about, but there was a large enough minority of people who believed that we were being too risk adverse with how we suggested to invest. So what happened? Well, condos are very expensive. They've got condo fees and property taxes. They still have some maintenance and utilities, etc. So what these people did was they took out these expenses and called a new rule of how to figure out if something was a good investment. Before, you just take the amount of money you make, your expenses, and if the money you made was higher than your expenses, it was a good investment. Now we had this really, hip, cool rule, which was the 1% rule, where you would take the purchase price, you'd multiply it by 1%, and then that would be the monthly rent that you would need. So it was great. If you bought a $400,000 condo, you didn't have to worry about any of the expenses. As long as you could rent it for $4,000, it was worthwhile. Well, that was great. That expectation was that these would be easy to find, and in the beginning, it was. And then what people found out is they could put a small amount of money down and they could purchase a place, a condo that would be ready 4 years in the future. And we were seeing 10, 20, even 30% growth in housing from 1 year to the next. So it went from a strategy of investing in a home that made more money in rent than the expenses to it not cash flowing, but this 1% rule worked, to then pure speculation. And these people bought homes never intending on closing. What they did was they wanted to sell these places before they were even ready to somebody else. And that was all well and good while housing prices were rising. But eventually that stopped. And the collapse in the condo market was swift. It happened so fast. And look, there was a huge amount of FOMO, fear of missing out, where people were actively advertising. I remember a realtor on the back of a bus saying, if you want your kids to own a home, you have to buy a rental property today. That was a very real advertisement that happened. And honestly, we were on that trajectory for a long time. But what we found is the cash flow ended up not being there. Then people started to try to sell these homes. And when they sold the homes, they were selling for the same price that they bought them for. Then there was a turning point where people were actually selling these condos for less than what they owed on them. So they had already put a deposit down. They were selling them for less than that and actually having to put in more money not to close on these places. So we saw a 30% drop in housing. Interest rates went up. There was a bunch of factors in place, but we saw a very quick collapse of the real estate market. Now, since then, rates have gone down pretty substantially, and we should expect both first-time homebuyers and investors to come back into the market. But there's one other factor that really comes to play. One is what we talked about already, which is condos take 4 years to build. So in some instances, we're still expecting thousands of condos to be hitting the market in 2026. And the second thing is one of the most highly effective programs that the government has ever produced in building purpose-built rentals. It's called CMHC MLI, and it has essentially had a boom of purpose-built rentals. So we are seeing actively today rents starting to drop. And for an investor, that is their worst nightmare, because for people who are doing things properly and looking at cash flow, if you have a steady rent or a rent that increases, you can determine, is my rent going to equal my expenses? But when rents start to decrease, trying to predict the bottom of where rents are going to go is extremely difficult. So figuring out whether you have a property that cash flows or will cover the expenses is very difficult. That's because investors look at properties very differently than first-time home buyers. So we have a market today for first-time home buyers where investors are actually completely on the sidelines. We will no longer have 68 offers where 64 of them are investors. We'll no longer have 50% of people or transactions that go through involving an investor. That number will basically be zero. And here's the amazing thing is there's no rush to go ahead and do this today. We're expecting, at least for the next year, probably the next year and a half, for investors to stay on the sidelines until we find the bottom of the rent. In that time, first-time home buyers are going to be able to find great deals. And do I expect that where condos in Toronto and Vancouver are today, that they're going to go up in value or stay the same? No, probably not. At the same time, there is and will be an opportunity for first-time home buyers to get into homes without having to compete with investors. This won't happen forever. And when investors go back into the market, you will see some competition come back as well. So what should you do? Well, the first thing that you can do is open up a first-time homebuyer savings account. It seems silly, but it's a combination of both a RRSP and a TFSA. So an RRSP is a retirement savings plan. When you put money into it, you get a tax refund at the end of the year. A TFSA has no tax benefit. At the same time, the amount of increase in value within that TFSA is not taxed. A first-time homebuyer savings account combines both. So opening one of these up, even if you don't intend to put money in today, you're allowed to carry over 1 full year worth of first-time homebuyer savings, so $8,000 per person. That's step number one. Step number two, make sure that your credit score is great. Housing is healing. Speculation is going by the wayside, and investors are sitting on the sidelines. This is your time to prepare and to be able to be ready when the time is right to jump into the housing market. I know that housing is way harder to get into than it was when your parents grew up. However, there will be no better time than the next year and a half to get into the housing market as a first-time home buyer.